Hello everyone. So this is part 2 of March 2020 AFM paper, question 3, right? In this paper, the question is about net present value, right? So now we are going to go through this question. So let's read, right? Yes, before going, we'll read the requirements because I have taught you that read the requirements first, right? And you can see the marks is for 6. You are even getting marks for 2 marks, right? So 6, 2, 3 and 6 and 8. First is evaluate, right? I'm going to write in my first part of this video where I discussed question 2 about exchange rate risk. I told you that you don't have to read the whole case, the whole case study, right? You can just read the parts of it which you need for your requirement and answer it. So I'm going to apply that technique right now. So I'm just going to read that part which is needed for the part A. So we are going to solve A, right? First we'll read all the requirements and then we'll just read those parts from the case study which we need for the requirements. Okay, so A, I evaluate the financial acceptability. Let me underline this word. Evaluate the financial acceptability of the project. Chi. Okay, investment proposal based on the chief engineer's forecast, assuming regulatory approval is granted in 1 year's time, right? Whenever you are given this word financial acceptability of a project, right, it mainly talks about net present value. You can write the thing which should come in your mind, pop out as the question is indirectly telling you to find the net present value, right? Finding net present value is the same as financial acceptability, right? If net present value is positive, that means it will be acceptable, financially it is acceptable. So that's the meaning of, I will write here net present value, right? Let's read the second part. Calculate the expected net present value of the proposal based on the finance director's assumptions about the likelihood of the recession and potential impact on the project's cash flow. So they're talking about not just net present value, they're talking about expected net present value, right? Calculate, right? So mostly first part and the second part is, if you can see, it is calculation part, not theory part. You need calculations, right? And it's just for 2 marks. That means it's not many workings, right? Just very few, maybe in 2 or 3 lines. Okay, based on whose assumptions? That means there are so many people who are making different assumptions. Now the third, calculate the net present value of the finance director's alternative option for the technology. Okay, so net present value, finance director's alternative option for the technology and advice board. You also need to advise board, right? That means 1 mark is for advising board whether this is worth pursuing or not. And finally, the fourth one, recommend whether the board should proceed with the application for regulatory approval after taking into consideration has the 70% approval rate with this regulatory application, or, so first, before going to or part, first we'll underline the board should proceed with application for regulatory approval after taking this, okay, or they should sell the concept now to GAPE, okay, or sell concept now. Include in your analysis any findings, any comments on your findings, okay, and B part. So all these are calculation except the first, the last part of A. It has some discussions, like you have to recommend, right, based on your calculations. You have to calculate also, you have to write also. And B part, if I can see, it's purely theory part, right? So explain the rationale for implementing capital investment monitoring system, right? So the main thing is capital investment monitoring system and post completion audit, right? Completion audit. Suggest ways in which Hathaway company may have benefited if this procedures has been applied to projects Lambda and Kappa, right? So they're talking about Lambda and Kappa projects. The benefit, how they are going to benefit if these two are implemented there. So each comes for 4 marks, okay? Now I will tell you how much you have to write, how much will you know, okay? It depends on your marks. So first, let's go to A. So first, it is for 6 marks, right? You can see. Evaluate the financial acceptability. That means just the calculation of net present value is 6 marks, right? So now I'm not going to read the whole thing. As you can see, projects Lambda and Kappa is for the last B part. I'm not even touching this right now, okay? But this I have to read, okay? The first 3 lines I have to read for me to understand the case study, right? So Heathrow company operates in the aviation industry, right? Manufacturing safety equipment for the commercial aircraft. The company has a policy of carefully appraising new investment opportunities, including the detailed analysis of all cost and revenue assumptions prior to their approval, right? So now project Chi. Okay. So project Chi talks about, okay, this is AI. So that means we will be using this part, this section for our first part. Hedby Company's board is reviewing a potential investment project G, and the company's engineers have developed a new technology which can detect the potential for mechanical failure with a greater degree of accuracy that has previously been the case. Early test results have been extremely encouraging. Okay, if the board accepts the engineer's proposal, Hedby Company would need to submit an application to the relevant regulatory authority. It is expected regulatory approval would be granted in 1 year's time. Manufacturing and sales would commence immediately after being granted regulatory approval. This line is very important now. Manufacturing and sales, okay, will commence immediately after being granted regulatory approval. When is regulatory approval going to be? In 1 year's time. Okay, regulatory will be granted in 1 year's time. That means after 1 year. So that means your cash flow is not starting from year 0. It will start from year 1. 1 2 3 like that. So even if it's starting from 1, that means you all your whatever you take your initial investment and all which comes in year 0 will now fall in year 1, because your year 1 is now year 0, right? Because you are getting the regulatory approval after 1 year, because it will commence after 1 year. The day you get the approval, your manufacturing and sales start. So that means it will start from year 1. Now, Hathaway Company's chief engineer presented an investment case for Project Chi to the board, including a summary of the following cost and revenue forecast and assumptions. Right, you need revenue and cost to make your cash flow, right? So let's read. Hathaway Company is expected to sell 3,000 units in the first year of production. How many units? 3,000 units in the first year of production, which demand increasing by 5%. Okay, demand increasing by 5% in each subsequent year of its 4-year lifetime. So you can see it's a 4-year lifetime means 1, it's starting from 1 1 2 3 4 and 5. 1 is the basically it is 0, the year 0, right? So 1 2 3 4 5, it's for 4 years. Okay, for 4 year, 5% each year it will increase. This sale forecast are based on a contribution of 5,000 per unit in the first year of production. So what is the contribution? 5,000 per unit in the first year, increasing at 2% per year. Okay, annual fixed costs 8.7 are expected in the first year of production. So first year, and increasing at 3% per year throughout the life of the project. So you have been given the sales unit, you have been given the contribution per unit, you have been given the fixed cost, and each of them increases throughout the year but in different percentages, right? It's very easy to calculate. Like now, by now something must have framed in your mind, even though you didn't go into the full calculation. Now let's read the second. An investment in plant and machinery of 12 million. So investment in plant and machinery 12 million will be required as soon as regulatory approval has been granted. The as soon as regulatory approval will be granted means they are talking, they mean that this is your initial investment. In other words, they are saying this is your initial investment. Let me write it somewhere. Where should I write it? Okay, let me write it here. Okay, so this means your initial investment they are talking about. So tax allowable depreciation is available on the plant and machinery at an annual rate of 20% on a straight line basis. Again, very important, tax allowable depreciation. Okay, annual rate 20%. Which rate? Straight line basis. When we were doing specimen paper, I told you there it was reducing balance basis, right? The tax allowable depreciation. In this case, it is straight line basis, which means it's very easy, right? So a balancing adjustment is expected at the end of the project when the plant and machinery will be scrapped. So balancing adjustments will at the end of the project, right? Even in specimen paper when we were doing this, we had this balancing adjustment thing. So you can see now, you can relate how net present value calculation goes. Tax is payable at 20% in the year in which profits are made. Again is very easy because same year. So 20% is tax in year which profits are made. And the relevant cost of capital to be used in the appraisal is 12%. So cost of capital is 12%. All the information is being given, right? And when you come to the second, okay, the finance director, however, raised the following objections and consequences to the chief engineer's presentation. That means we don't need this part because our part AI talks about oldie. Okay, proposal based on chief engineers focused, right? We are not talking about the finance directors here. We are already talking about chief engineer. So chief engineer already presented the first one. This part is about the finance director's assumption. So we are not touching this part. We know that this part comes for your second part. That is this part. Right? So we are not going to touch it now. Now we know what we have to do. So I will take you to the answer and show how the answer is presented. This is the answer is presented, right? Net present value. All figures are, right? It's always better to not to deal in millions, right? So just write a statement that all figures are in million, right? So that you don't have to each time put zeros and waste time, keep adding zeros and all. That's all a very smart and efficient way for you to do it fast, right? You can see it starts from 1 2 3 4 and 5, right? You have been given the first item is contribution, right? Because usually we are so used to writing sales and then minus cost and all. Now it's contribution, right? And they have been given working one. So this thing, don't underestimate that, right? This means I have been telling you that don't do your workings in the main table where you are going to present your answer. Your table, your main answer, this table. Just see this table. Okay, just see. This should only look like this only. There should be no working in this table. No working should be done on this table. It's very neat, right? If you want workings, it should be on other page, on a new page. And mind you, your main answer should always be coming first, then your workings. That's why I always tell you that leave 1 or 2 page for your main answer and then you can do your workings, because you don't know how much page you need. Because even though you present your final answer first, your workings you will be calculating, right? You will be doing your workings first. Even though in order, this will be presented first, right? Even in the exam sheet, yeah, in your paper, keep your main answer and then comes your working. Don't present your workings first and then your main answer, right? So this is your working, right? Now working one is contribution. So you can see from 2 3 4 5, right? Why not 1? Because 1 is basically it is year 0. that is your initial investment, right? So it will start from year 2, right? After 1 year means starting of second year. So everything starts from second year, second, 2, 3, 4, 5. It's on a 4-year period. Okay, so volume has been given, right? So now let me take it to the question again. This only this portion we are using it. So you can see I have underlined sell 3000 units in the first year. After that it's increasing by 5%. So just increase every year by 5%. So that's why it's 3.15, because it is into like this, right? For the third year and then fourth year again 5%, again 5% on that, right? And it has been rounded up to 2 decimal places. Keep it into 2 decimal places. Okay, whenever you're given an answer format like this, always round up to 2 decimal places. So you are getting the volume, and then let's go to the contribution per unit, right? Because contribution is nothing but sales minus your variable cost. That is your contribution, right? So already they have not given you cost, but they are giving you contribution, right? Contribution per unit has been given as 5. When we go here, we can see 5,000 per unit in the first year, which is increasing by 2%. So increase 5 by 2%, again 2%, again like that, keep increasing. And then contribution is nothing but your volume, right? Let me put this. Volume multiply by your contribution per unit. 3 into 5, 15. 3.15 into 5.1, you'll be getting 16.07. And also all this, only all this amount are there in your contribution table. Just check here. 15, 16.07, 17.21 and 18.43. Now let's go to the fixed cost. For fixed cost, they didn't do any working because fixed cost they just inflated, right? So fixed cost in the first year has been 8.7. Yes, annual fixed cost 8.7. Now this is in the first year itself, because you are anyway, because they told that this is in the first year of production. They have told are expected in the first year of production, increasing at 3%. So inflate 8.7 by 3%, and then deduct that fixed cost from the contribution, and then you also have to deduct your tax allowable depreciation. Your tax allowable depreciation, you didn't do any working this time because it is straight line basis, right? And it is just the 20% of your plant and machinery, which is 12 million. So take 20% of 12 million, which is 2.4 for the 4 years straight line basis. So it is the same amount for all the 4 years. But when you come for the 5th year, the last year, this balancing adjustment, right? This 2.4, how you got it? Just from 12, keep deducting your tax allowable depreciation always, right? Your tax allowable the balancing adjustment at the end, if you want to calculate, right? You have to calculate most of the time. Then what do you have to do? Your fixed cost, okay, your cost of plant and machinery. In this case, it is 12 minus all the years tax allowable depreciation. So keep deducting 2.4 for the 4 years. So basically it is 2.4 into 4, which is 9.6, because for 4 years 2.4, right? And then you will be having 2.4. So this 2.4, still 2.4 is remaining. So again this needs to be deducted, because at the end your balance has to be 0. So this 2.4, right? This 2.4 is this tax allowable, this balancing adjustment, right? So, and finally, always in all the cases from your fixed asset, when you deduct your tax allowable depreciation of all the years, right? Accumulative tax allowable depreciation, at the end it has to be 0. If it is not 0, the remaining portion, in this case that 2.4, is the balancing adjustment, which will be in the last year, right? Then you are getting your taxable profit. On this taxable profit, you are taking 20% because tax is 20%, and you are deducting. And now let's go to this part, add back depreciation. Why are we adding back depreciation? Okay, So here is the logic why we are adding back depreciation, and you always have to add back the depreciation. Always you have to add back the depreciation, because this tax, this, okay, this TAD, okay, tax allowable depreciation, we are deducting from the fixed cost, right, from our revenues and from the fixed cost. After deducting, we deduct tax allowable depreciation because we want to find the taxable profit, because we are not taking depreciation into account, right? We have to deduct the tax allowable depreciation because so that it reduces our profit, right? If it reduces our profit, the tax will be low. Because of tax allowable depreciation, you are saving tax, right? So you are saving. How will you show that you are saving tax? By reducing the tax. How will you reduce tax? You have to reduce the profit. How will you reduce profit? Deduct tax allowable depreciation. Exactly. So that's why you're deducting tax allowable depreciation, because always you have to deduct. You want to reduce profit. You want to reduce profit, you are reducing tax. That means you are saving tax, because tax allowable depreciation means you are saving tax, right? Because depreciation is a non-cash item, right? When you calculated profit, you deduct it there. So now why are we adding back the depreciation? Because we only deduct this tax allowable depreciation to find the tax. Our purpose is to find the tax, right? But when we want to find the cash flows, right? When we want to find the cash flows, we don't deduct tax allowable depreciation. That's why we are adding it back. In other words, if you don't want to show that add back depreciation, right? You don't deduct tax allowable depreciation when you want to find the cash flow. Only for the purpose of tax, you are deducting tax allowable depreciation. In other words, you are just taking 15 minus 8.7, right? And from this you are deducting your tax, which is 0.78, right? And you'll be getting 5.52. You'll be getting the same answer whether you add or it's simply you are not deducting 2.4. The tax level depreciation you are not deducting in the cash flow, right? Because depreciation is a non-cash item, it needs to be added back. You cannot deduct it to find cash flow. That's why, right? Depreciation is a non-cash item. You cannot deduct it. It has to be added back. So that's why you are adding back the tax allowable depreciation. So except this is 4.8 because it also has a balancing adjustment and tax allowable depreciation 2.4 and 2.4. That's why it's 4.8 in the final year, right? Whenever you have to find the cash flow, always you have to add back the depreciation. First time you are deducting. Now you might be asking why we are deducting first and then again we're adding. What's the use? Just eliminate. No, for the purpose of finding this tax, right? Tax 20%, right? You are finding tax on what? On taxable profit. So that taxable profit needs to be reduced. So only for finding tax, you have to deduct tax allowable depreciation. After that, once you have got the tax, then you have to add back the depreciation again when you are finding cash flows, because depreciation is a non-cash item. So now here it is 12, the investment cost is 12, right? Because they have been told that is the initial investment. And then it has been discounted at 12% because cost of capital is 12%. And finally, they have calculated the net present value, which is positive, right? Now let's go to the second. So we are done with the first. We are done with the first requirement, right? This is over. Let me put a tick. Now let's go to the second, which is 2 marks. So calculate the expected net present value of the proposal based on the finance director's assumptions about the likelihood of a recession and potential impact on a project's cash flow. So now we have to read which part? This. The project's extra information. So only this we need. Right? So the finance director, however, raised the following objections and consequences to the chief engineer's presentation. The chief engineer's cost and revenue assumptions ignored the possibility of a recession, which has 20% probability of occurring. So recession has 20% of probability. Okay. In a recession, the total present value for the 4 years of production are likely to be 40% lower. Total present value 40% lower in recession. Okay. In a recession, we already have calculated the net present value in a first part. So now 40% lower, okay, when recession is there. So the finance director also believes there's an alternative. Mutually exclusive development opportunity based on the new technology. Okay, all these things are not needed. We are not reading it. Why? Alternative part comes in the third requirement. What we need, and this is for 2 marks. So for 2 marks, you don't need so much of information. Right? We already need to know the impact of recession on cash flows. That's it. We have got it. So now let's go and do it. Expected net present value, they asked. So then expected net present value. See, clearly they are writing the headings. Right? Expected net present value of the chief engineer's proposal. So what is the present value from year 2 to 5? Right? This one is nothing but just the addition of this. You just add all 4, but you don't deduct this. You don't deduct the initial investment. 10.72 you don't deduct. If you add all the 4 years present value, you'll be getting 17.74. Right? And 60%, because they told 40% lower. 40% lower means 60% only. Right? With recession. So that's why 60% of 17.74 is 10.64. Then we have to find the expected present value. You know what is the formula of expected present value, right? Now you need to use probabilities here. Expected means you have to use probability of something happening, right? So they have clearly told what are the present value. What is the probability of recession is 20%. So that's why it is 0.2 into this. Why probability of recession is 20%? Why 10.64? Because that is the present value after recession. 60%, 40% lower, this one. That's why it's 0.2 into 10.64 plus 80%. 80% there will be not recession. It will be normal only. So normally the present value is 17.74 only. That's why it is 0.8 into this one and this one. And add both, you'll be getting 16.34, right? With this, you deduct 10.72. This is your initial investment, right? And then this is your expected net present value using under recession. So you can see that it reduced. Before it was 7.02. Now after recession, it is 5.6, right? It does make sense. Like now, suppose if you're getting a higher expected net present value after recession, under recession, then you have to be very curious. Then you know that something is wrong in your calculation, right? Your calculation has to make sense, It cannot be higher than 7.02. That you know for sure. So whenever you do calculation of this type, just make sure that because recession, of course, it will be lower than that one. So this is lower than 7.02. So it makes sense, right? So that your calculation is somewhat correct. Now let's go to the third requirement. The third requirement talks about calculate the net, and is for 3 marks, right? Calculate the net present value of the finance director's alternative option of the technology and advise the board whether this is worth pursuing. So now let's read that part which we left, right? Okay. Okay. So the finance, I'm reading from here. The finance director also believes there is an alternative mutual exclusive development opportunity based on the new technology, although this will still depend on its being granted regulatory approval. This alternative option would incur an identical investment cost of 12 million, but So identical investment cost is 12 million, right? But generate annual, that means per year, it will be same. Inflation adjusted, already it has been adjusted for inflation, you don't have to worry. Post tax, already tax thing, it has been adjusted for tax. Cash flows is over 3.43 million over a 7-year life from year 2 onwards. So yeah, from year 2 onwards means after the first year. So that means each year it will be 3.43, 3.43, 3.43, like this for 7 years from year 2 onwards. So year 2, year 3, year 4, year 5, year 6, year 7, like that. Now let's go. The investment, okay. Basically, wait a minute, just go. They are talking about the 70% approval rate in fourth part. So even in this, they are talking about the 70% approval. So we don't need this. We don't need this paragraph, right? Now we can do with this piece of information, we can do it. Okay. So alternative option, net present value, annuity factor. Annuity factor, why? Because annually it has been uh, the same cash flow. So whenever the cash flow is same annually, annuity factor you have to use. Annuity factor is at 12% and T2 minus T8. I will explain why it is T2. That means time 2 minus time 8, or year, you can say year 2 minus year 8, right? And 12% because cost of capital is 12%, right? And why time 2? Because it's starting from year 2 onwards, 2 years 7 means it will fall in year 8, right? Because we are starting after 1 year. So that's why it's 2 minus 2 to 8, right? It's not 2 minus 8 from year 2 to year 8. Okay, so the annuity factor, okay, you will get, okay, when you go through that table, annuity factor table, okay, check 12%. Okay, let me tell you, it is percentage is 12 and your n number of year will be 8, right? Your number of year will be 8. So when you go to 8, you will find 4.968. From there, you have to minus the first year, because first year you are not. That means year 1. Year 1 annuity factor. It is 0.893 you have to deduct, because it is starting from year 2 to 8. So first year you don't have to take. First year you have to minus. Right? That annuity factor 4.968 includes from year 1 to 8. So that first year you have to take it out. That's why you are minusing by 0.893 and you are getting this, right? With this annuity factor, you are multiplying by the present cash, the cash flow, which is 3.43, right? This has been given annually and you are getting 13.98. That is the present value. Now deduct initial investment, which is 10.72 only. Why? Because they told that capital, they have mentioned here that identical investment cost is 12. So even if you use identical cost and find the present value, it will be 10.72 only, right? Cost of the initial investment is 12 million. It is same. That's why you can use the same present value of the same initial cost, 10.72 minus, you will get the net present value. Now just check, just compare this and this and see which one you will suggest. Of course the first one, right? 5.6 million is greater than 3.26. So therefore, you also have to recommend. They told you to recommend whether it's worth pursuing or not. So therefore, it is now more beneficial. Okay. To follow the chief engineer's proposal. This line needs to be there. Without this line, you will not get that 1 mark. Just doing calculation is not enough. You will lose 1 mark because let me take you to the requirement again. Just read the third part. Calculate the net present value of finance director's alternative option for technology and advise the board whether this is worth pursuing. Advise the board whether this is worth pursuing. It's just for 3 marks. So just one line is enough, right? This is not the recommendation which you usually write for long paragraphs. Just one line is enough. It's for 3 marks, right? 2 marks for your calculation, 1 mark for your writing, advising that. Now let's go to the fourth requirement. So, and it's for 6 marks, right? That means it has calculations and it has theory part. Recommend whether the board should proceed with the application for the regulatory approval after taking into consideration the 70% approval rate with this regulatory application. So this is the first thing. You have to recommend whether they have to go by this or that, or to sell the concept now to GAPE. Include in your analysis any comments on your findings. So let's go to this paragraph and see. You need only this. Only this paragraph is important for the last requirement. So the investment case assumes regulatory approval is certain, whereas historically only 70% of the application has been approved. In 1 year's time, if the regulatory application is not approved, it is assumed that the concept can be sold to GAPE for 1 million at that time. Sold to GAPE at 1 million at that time. This is very important. What is it emphasizing on? At that time. Why are they saying at that time? That means you have to find the present value. What is it today? You need to find that present value of that 1 million. That's why they are saying at that time it is 1 million. But what is it now? Today, you have to find the present value. It is not in terms of present value. Okay. If the board rejects the proposal now, assume that the concept can be sold for 4.3 million immediately. So they have two options. First, they can sold the concept, they can reject the proposal and sell it for 4.3 million immediately, or they could wait for 1 year. They have a 70% chance of getting their regulatory application, right? Then, okay, concept can be sold to GAPE company for 1 million at that time. One of these two. So now let's go to an answer and see how it has been given. Apply for regulatory approval or sell, right? So next, consider decision to sell now or to continue with application for regulatory approval. Now let's see what happens. Net present value of sale to GAPE company now is 4.3 million. They have already given it. That is 4.13 million, right? But if you go by the regulatory approval, what is the expected net present value? Right? It is 0.7 because 70% of getting regulatory approval. Why into 5.6 million? Because regulatory approval, if you are going by that, right? And also taking recession into account, your net present value, if you go, this one comes from your part B. Exactly, it comes from your part B. You see, each one is linked. That's why I always advise to do in order, because each one is linked to each one. You will use it. You need the previous information. Sometimes you need the previous answer for this. So that's why they are taking that net present value, because that is based on the regulatory approval after taking recession into account, right? So that's why they are taking this net present value. Let me again check whether there is any hint for that or not. Yes, you have to take that after recession, right? And then this 0.3 is when not the regulatory approval, okay, not getting the regulatory approval, 30% chance of not getting it, right? So 30% chance of not getting it, multiply by this into this. This 1 million they have given that you can sell it at that time for 1 million, but this needs to be discounted again. Discounted at 0.893. Why? At 12%. Because the cost of capital is 12%. It needs to be discounted at 12%. That means 1 over 1.12. You will be getting 0.893. Right? This is after 1 year. So before 1 year, if you want to find, just discount it at 12%. Right? Multiply by 30% because 30% no regulatory approval. That means you will sell. But 70% multiply by the net present value because 70% there's a chance of getting the regulatory approval. Add both, you will get an expected net present value. And now just check which one is greater, this 4.3 or 4.19. 4.3 is greater, right? So therefore more beneficial to sell immediately to Gape company. It's more beneficial to sell immediately because net present value is 4.3, whereas expected net present value of you wait for the application of regulatory approval is 4.19. But this is not enough. You need to recommend and comment, right? You need to comment on any findings they have clearly told you, and you need to recommend. Your recommendation is just one line, right? Immediate sell to Gape company for 4.3 million. This is your recommendation. Because why? Higher net present value. Now let's see the comments. If you didn't put this part, this comment has not been included in your answer, you are losing few marks. You will be losing because you are getting marks for these comments. They have clearly mentioned, right? Whenever they give something like this, right, include in your analysis any comment on your findings. You cannot tell that you haven't found any comment. You cannot do any comment on your finding. You cannot say like that. You cannot be in a position. You have to put comments on your findings. Okay, so this is what they have done. So based on the chief engineer's assumptions, the project generates a positive net present value of 7.02 million, right? A positive net present value. You have to mention it's a positive. This is based on the first net present value, the first calculation which we did, part A. Okay, and should therefore be accepted in preference to the option to sell the concept for 4.3 million. They are saying that the project is generating a positive net present value, therefore this should be accepted rather than selling the option to sell. Why? Because you will only get 4.3 million. So on the other hand, when the finance director's objections are incorporated into the appraisal, this is when the recession thing has been incorporated. The expected net present value is only 4.19 million. Right? And should therefore be rejected in favor of the option to sell. Now when you compare with the option to sell, it's better to sell because 4.19 is less than 4.3. Right? It should be noted that the expected net present value of 4.9 is an average. In other words, it is the average net present value if the project is carried out repeatedly, which may not be useful in the case of one-off development opportunity. Now you have to see, may not be useful in the case of one-off development opportunity. When you are using a one-off development opportunity, this is not a good method because net present value of 4.19 is average. That means if you carry the project continuously, then only this is a good method. If it's for one-off development project, it's not a good appraisal technique. Right? So based on the calculations above, this is how you are going to write your comments. You are not going to come here and do calculations again. You have done that part already. Your calculations has been done. Now you just have to say like this. Your sentences has to be based on the calculations above. Right? There is a 30% chance that the net present value will only be 893,000. How? From how they got like this? Let me do it again because I have right 30% chance. Let's go up and I will show you how. Just check. This is 30 into 0.893 into 1. So 0.893 into 1 million is 893,000. That, and it is 30% chance. You see, only 30% chance of occurring this. So 0.893 into 1 million. So that's why they are saying there's a 30% chance that the net present value will only be $893,000, which may pose a risk. Why 30% only? Where is 70% of not having this net present value, right? So which may pose a risk the directors are not prepared to take. The director's attitude to risk will be an important factor in the final decision. Always, if you have seen how this comments and how this recommendation of choosing a technique or choosing this project or that project or hedging technique goes, always they have mentioned this director's attitude to risk needs to be taken into account. This thing has been repeated many times. So whenever you write, you also put the sentences in the answer, right? And now comes this part. This is very important. This, right? Don't forget to mention these things. I can put a star here, or double star maybe, so that you know that it's very critical, it's very important that you put these lines, the importance of these lines, right? So furthermore, the analysis largely depends upon the values of the probabilities prescribed. Exactly. The probabilities can keep changing, right? The way you put the value for the probability, 30%, 70%, the analysis will largely depend on that. The range of possible outcomes and the accuracy of the revenue and the cost assumptions. Sensitivity analysis, always mention about sensitivity analysis, especially in the case of net present value, right? Sensitivity analysis may be useful in testing the impact of variations in each of these variables in the final outcome. What is sensitivity analysis? Sensitivity analysis is you are testing under each condition. You are changing one variable and seeing what is the outcome. So you are changing maybe cost, maybe revenue, and seeing what is the impact on the net present value. So that's why always mention about net sensitivity analysis, right? They are saying that this will be useful in testing the impact of variation. That means different variations for different variables on the final outcome. Always put this in the last, your last few lines, your last paragraph have to talk about you have to talk about sensitivity analysis, especially for the net present value questions. Now let's go to part B. Part B is a theory part, and it talks about explain the rationale for implementing capital investment monitoring system and post completion audit, right? You have to give reasons, suggest ways in which giving reasons is not enough. You also have to give ways in which the Hathaway company may have benefited, right? If they have been applied to Lambda and Kappa, okay, projects. So for that, we need to read this paragraph, the last paragraph, right? A recent board meeting discussed two recent investments, Project Lambda and Kappa, both involving the construction of new manufacturing plants for safety equipment. Both projects are now operational, although projects Lambda experienced significant time delays and cost overruns, while project Kappa was under budget and within schedule. This needs to be highlighted. What is that? Lambda, time delays, cost overruns. Kappa, under budget, within schedule. Right? One project is doing good, one project is not doing good. Now let's do. On the closer examination, the directors noticed the project Lambda's revenue far exceeded initial expectations. Revenue far exceeded initial expectations, whereas project Kappa's revenue was much less than originally expected. Kappa's revenue was less than originally expected. On balance, Hathaway's chief executive officer suggested that each project's success compensated for their respective failings. That means in one thing they are doing good, but in the other thing they are doing bad, so they are balanced. And that this was to be expected when making predictions about future in an investment plan. However, one of the directors suggested the company could benefit from the introduction of capital investment monitoring system and post-completion audit. The directors agreed to discuss this in greater depth at the next board meeting. That's it. So now let's see how the answer has been framed. Okay, so while Hathaway investment plans are based on a detailed analysis of all cost and revenue assumptions, Project Lambda and Kappa highlighted failings in the appraisal and implementation phases. Let's see. First, they're talking about capital investment monitoring, and then they talked about the audit part. So you need to clearly distinct between these two things. Don't talk about one thing only, or don't try to combine these two things. These two things are two separate things. Okay, so capital investment monitoring. Just reading your textbook is enough for you to get the theory knowledge of this. Okay, for this type of questions, to get the theory part, just reading your textbook is enough. Right. So let's read capital investment monitoring. Capital investment monitoring involves reviewing the implementation of an investment project to ensure it progresses according to the original investment plan, time scale, and budget. So the main aim of this is they are monitoring how well it is going, how well the investment project is going with the actual plan, the original plan, right? The progress, just to check the progress. This involves assessing the risk associated with the implementation phase and identifying deviations from the investment plan so that remedial action can be taken where necessary. Controls should be established to ensure effective delivery of the project. Okay. Effective investment monitoring may have avoided the cost overruns and time delays. Right, exactly. This has been taken from Lambda, right? Project Lambda, you saw that they have faced this cost overrun and time delay. So this could be avoided if they would have gone for effective investment monitoring experienced by Hedwig Company's Project Lambda. Okay, and the appointment of a project manager would have ensured ownership of the project and provided accountability for the time delays and cost increase. They are saying if they would have appointed a project manager, right, then this things would have been solved, or these things would have not happened, right? Because the project manager might have taken the accountability, the ownership of the time delays and cost increases. So the original investment plan, including cost estimates, provides a benchmark, okay, against which actual performance can be assessed. An effective monitoring system would ensure that any changes to the cost estimates would be justified and authorized. So if you're having an effective monitoring system, what's happening is even if you make some changes to the cost estimate, this will be justified and it will be authorized, rather than just changing the cost estimate according to your needs without having a proper monitoring system. And where significant deviations are encountered, it may be necessary to terminate the project, right? If there are so many deviations between the plan and the thing which is actually happening, there's no progress, then it is better to terminate the project. It is necessary sometimes that you have to terminate the project, right? A project steering committee would ensure greater scrutiny and accountability and oversee the implementation phase, right? Whenever, especially you're talking about a project in this case, so whenever this type of question emerges about project and all, it's better that you know something about project, the role of project manager, right? So that you have something to talk about. It's better to bring these points because this is a project. Now let's talk about the post completion audit. A post-completion audit is an objective after-the-fact appraisal of all the phases of the capital investment process regarding a specific project. Each project is examined from conception until as much as a few years after it has become operational. Right? It is been under examination. It examines the rationale behind the initial investment decision, including the strategic fit and efficiency and the effectiveness of the outcome. Then the key objective is to improve the appraisal and the implementation of the future capital investment projects by learning from past mistakes and success. So that is the importance of this. Now let's see here. And effective. Okay. An effective post-completion audit may have identified the reasons behind the failure, right, of Project Kappa to achieve its focused revenues. Right, their focus is behind, their revenue is behind the focused revenue. Why is that? These reasons could be identified if they would have gone for the post-completion audit. By comparing the actual project outcome with the original projections, an audit will examine whether the benefits claimed prior to approval ever materialize. So audit is not an academic exercise. An effective audit would identify failings and help the company to learn from past mistakes as well as replicate its successes, and Project Kappa's principal failing seems to be the inaccuracy of the revenue assumptions. Right? An audit would establish the reasons behind that failing and identify ways in which this can be addressed. For example, it is possible the initial assumptions failed to predict future competitor, right? So maybe initially you must have assumed that revenue will be like this is the price I'm going to charge. But what happens when a competitor comes into place? Your assumption needs to be updated. It needs to be keep changing with the changing in the business environment, right? We all know that business environment, the risk we are facing now changes very rapidly. So your assumptions cannot be fixed, cannot be rigid, it needs to change. Maybe you have some initial assumptions in the beginning, but due to a new competitor coming in the place, now you have to change your assumptions, right? So that's why they are talking that initial assumptions, they might have failed to predict future competitor actions or the full range of potential economic scenarios. There could be changes in the exchange rate, interest rate, so many things. In this way, healthcare company managers benefit by learning how to appraise investment proposal more accurately and implement them more efficiently than before, right? And credits will be given for alternative and valid discursive comments. And you can just learn from here, right? This is also an advantage of learning from past papers and mock. The theory part and all you can learn. You can take some of the sentences from there and learn it, because there are some things which are addition, which are not there in the textbook, which you can learn from the past paper. Like for example, this post completion audit, you can learn what are the roles of it, what are the advantages, what are the benefits. You can learn from this. And also the capital investment monitoring and all you can learn, even though it's there in the book, right? So that's it for this question. So we have gone through all the question, and this seemed a very easy, pretty much a very easy question, right? It didn't take so much of time also, right? So you can see the benefit of me going following that order, picking up the sentences, picking up the paragraphs which is relevant for a particular requirement, only reading and then answering, and then going to the next requirement. You see how much time we have saved. So this is a very great time saver, right? I hope that this will also help you. Now for this paper we only have the first question left, question 1, which talks about accusation. It is about accusation. And also that question is a little bit tough, like many people have found that question a little difficult. So I will be making that, right? I will coming up with that too. So don't forget to watch that too. And I hope that you like this video. If you have liked this video, please like this video, comment and share with your friends. And don't forget, right, that I'm coming live on 1st December. So don't forget. So stay with me. Join me in live and ask your questions, ask your doubts, and I'm all there to help you guys out with all the resources, with all my experience, with all the knowledge I can provide to you people, right? Because this is a time to help each other out, to help all the people out, to help everyone to pass, right? And best of luck to all of you, and have a great time. Take care.